Good morning, and thank you so much for joining us for the first event in this year's Learning Exchange series, More Than a Moment. Today's program is called A Collective Voice, the Community Development Finance Movement. My name is Valerie Lee, and I'm Virginia Community Capital's Corporate Marketing Director. And before we get started, I wanted to just address a few administrative items. First thing, this event is being recorded, and we are going to share that recording with everyone who's registered for the event via a follow-up email next week. Also, we acknowledge that Teams might be a new tool for some of our guests today. And actually, this is our first time using the Teams webinar function, so we're going to be learning together a little bit. But while the interface looks different than Zoom, it actually operates really similarly, and many of the features are the same. So if everybody looks up to the top toolbar, from left to right, you'll see buttons for viewing participants, opening the chat, making a reaction, and submitting a question. All attendees are going to be muted during today's session. Throughout the program, you may submit questions via the Q&A tool, which again can be found in the top toolbar at the top of your screen. It's the speech bubble with the question mark inside of it. We're going to hold all of the questions submitted until the Q&A session at the end of the panel discussion, and we're going to try to get to as many of those questions as we can. And then finally, please feel free to use the chat to share information with your fellow audience members. The chat icon is the square speech bubble with horizontal lines inside of it. Just be advised that we're not going to be monitoring the chat for questions for our panelists. So again, please submit those questions using the Q&A tool, which is the round speech bubble with the question mark inside of it. So now, with that, I'm delighted to introduce Virginia Community Capital's President and CEO, Amir Kirkwood. Amir joined VCC in the fall, and he brings with him over 20 years of experience in community development finance. Amir previously served as Chief Investment and Network Officer at Opportunity Finance Network, a national association of CDFIs that helps money flow to communities underserved by traditional finance by providing capital, advocacy, and capacity building for its members. Prior to joining OFN in 2019, Amir served as first vice president for commercial banking at Amalgamated Bank, where he worked as lead originator for mission-focused lending to nonprofits, CDFIs, impact investment funds, and foundations. Also serving as senior advisor to the Amalgamated Foundation, he advised nonprofits, CDFIs, and investment funds on impact finance strategies. So with that, I will turn the mic over to Amir, and Amir, take it away.
Thank you very much, Valerie, and welcome everyone to the first event of Virginia Community Capital's 2022 Learning Exchange. On behalf of the team at Virginia Community Capital and Locus, I am pleased to be able to host you for today's event. Last year's Reimagining campaign was a discussion about the need to reimagine our roles as community development stakeholders. While our communities continue to recover from so many challenges of the past few years, we at VCC recognize the need to look past the individual moments and commit to the movement, as we have seen the need commit to the movement for future community development through Virginia and throughout the country. As one of over 1,200 CDFIs operating as banks, loan funds, or credit unions, VCC is committed to working with our stakeholders in Virginia and beyond to take what we have learned since 2020 and find new ways to support community revitalization. Building on our learning exchange events in the past, which were unfortunately on hold for the past 2 years due to the pandemic, we're here today to reignite these opportunities for thought leadership with a mission to continue the conversation, sustain the movement, and make this more than a moment in time. In today's conversation, A Collective Voice, the Community Development Finance Movement, we want to examine the community development movement and explore how CDFIs work together to shape policy, inform program design, channel capital into communities. From this event, what we hope you're able to take away include an understanding of the movements supported through community development finance, the advocacy role that CDFIs can and should play, why CDFIs have received so much federal funding, particularly in the last few years, and then just how to work with CDFIs going forward. So let's begin. I'll start by introducing you to today's moderator for the Learning Exchange, Leah Freemow, who's a familiar face in the Virginia economic development community with a rich background stemming from multiple sectors. She currently serves as Senior Vice President and Director of Community Innovation at Virginia Community Capital. She partners with businesses, nonprofits, and localities in a variety of industries and growth stages to support their capital needs and move them to the next level. Leah will be joined by our panelists today, what a great group of folks we have today to share their experiences. First, Jess Lemon, the senior commercial banker with JP Morgan Chase. Defina Williams, Senior Vice President of External Affairs at Opportunity Finance Network, the trade organization for community development financial institutions, and Robert James II, who is the Director of Strategic Initiatives at Carver State Bank and President of the Carver Community Development Entity at Carver. So with that introduction, I will turn over today's conversation to Leah. Thank you, Leah.
Great. Thank you, Amir. It's great to be here with you all in the audience and with our guests today. We've structured a conversation for you all. So rather than kind of doing a panel format where I go down the line and ask everybody a different question or sometimes the same question, we thought it'd be more engaging to just have a facilitated conversation with our leaders here today. And so doing that a little differently, even on the front end. So rather than me reading bios that you could Google search or we sent out in an email, we've asked our panelists or our guests to talk about their background a little bit and their relevance, how their work is connected to the movement and the reimagining of the community development finance system that we're living through right now, but share it in a way of a personal story and a personal connection to the work that they're leading in this industry today. So to kick us off, Defina, do you mind getting us started with a personal connection or a story about your experience and your connection to the movement that we're all part of?
Sure. Thank you so much for having me today. As Leah mentioned, I'm the SVP of External Affairs at OFN, and I've been privileged to work on policy in the community development finance field and see a lot of growth and change over the 15 years or so that I've been working in this space. So I actually came into the industry on the front end of the financial crisis in 2006. And CDFIs in a lot of ways, I think, were canaries in the coal mine back then. They were some of the first voices in calling out what was happening in the subprime mortgage market and really identifying the wave of defaults that were coming. And so when the economy eventually did begin to buckle during that crisis, there were a lot of expectations in the field that because of who CDFIs were working with and lending to, that there would be widespread failures across the industry. And a handful did actually close down. But what we actually wound up seeing is that CDFIs were leaning in as the crisis deepened, lending and investing more as traditional finance was retreating from our communities. So I think the financial crisis, we learned a couple of things about CDFIs. That solid underwriting, relationships with borrowers, and a strong balance sheet and equity can help weather a lot of external forces. And also that CDFIs are counter-cyclical, that our customers and communities are already working with limited resources and challenges being shut out of markets. And we know how to push through and really work through difficult circumstances. So after a few wobbles and some rough quarters in 2008, 2009, things really started to shift. And we actually saw CDFIs are really performing quite well and outperforming other lenders. And that started to get the attention of policymakers who actually started to make some big investments in the sector through some of the financial crisis legislation that passed in that time period. So we saw supplemental appropriations to the CDFI fund, and we also saw the creation of programs like the Small Business Lending Fund and the Community Development Capital Initiative. But we also saw a shift in the role of CDFIs as partners for governments. We're being called on to administer programs like the State Small Business Credit Initiative. CDFIs were receiving funds from some of the Department of Justice housing and mortgage market settlements. We were seeing a real interest develop in helping CDFIs access low-cost, long-term capital through the creation of programs like the CDFI Bond Guarantee Program and opening the doors to the Federal Home Loan Banks to community development loan funds. And those investments in CDFIs and our capacity really helped to drive financial and reputational growth in the industry. But I think CDFIs still weren't quite household names, and that was until the COVID-19 pandemic and the Paycheck Protection Program. And I think that's when we really saw CDFIs go kind of from that best kept secret in finance and maybe a pet project of a few elected officials to really a household name getting continuous coverage in mainstream media. And so I think that the story of PPP will be one of those that we look back on as a defining moment for the CDFI space, where we really took our place as a critical part of the financial services landscape, this dynamic network of specialized lenders who actually knew how to reach communities that others struggled to serve. I think it hasn't all been a bed of roses, right? CDFIs were initially shut out of that first round of PPP, and we pushed really hard to be included to get access for our customers. But we were met with kind of a common refrain that we were too small and we didn't have the capacity to move the amount of money as quickly as it needed to move. But I think once that first round of funds went out and essentially missed the smallest, most vulnerable businesses, and it was a big media story, there was a real shift in our role. Very senior members of Congress were calling, the administration and their staff were reaching out, asking for ideas and how they could best support the CDFI industry. And that's where we saw things like the Community Financial Institution Set Aside that was first created in that second round of PPP, where all of a sudden CDFIs, MDIs, CDCs, and micro lenders were front and center, and we were really thrust into this new level of attention and support. And then the George Floyd murder happened and the racial justice protests started, and that just further amplified the role of CDFIs in these renewed conversations around racial and economic justice and systemic inequities. So we had kind of these intertwined crises of health and race and economic issues, and somehow our little sector of that financial system was on the front lines of helping to address them all. And so the public and private sector started looking for ways to invest and support vulnerable communities, and they needed partners. They needed real partners like us who were on the ground, who understood the needs and the challenges. And it became apparent that, we weren't going to have an equitable recovery of any kind without CDFIs and MDIs, and that we needed to be central to the fixes and not on the sidelines trying to force our way in. And so I think that's where the real shift has been, is that CDFIs are now at the table. We're now part of the conversation. We're now included in those discussions around how we get to a more equitable and just economy. And it's a far cry from, I think, where we were when I started back in 2006.
Yeah, Dafina, thank you for that. And some of your remarks personally resonated with me because I now know my husband knows what a CDFI is, after 6 years of working for one, because of all the mainstream attention that we're finally getting as an industry. But it didn't just start in 2008. Robert, do you mind sharing your story and your connection to the CDFI industry and a walk back in history with the bank that you're connected to?
Sure, Leah. Thank you so much. And thank you to Virginia Community Capital and Amir for inviting me to this important conversation today. As we talked about in some of our pre-meetings, I think it's really critical that we join forces across the CDFI and impact finance space in order to maximize our impact. And we need to start breaking down some of the walls that have been erected between us by, some of them self-erected, quite frankly. And so we need to start getting past some of those divisions so that we can, maximize our impact in this really important moment and turn it into a movement. So I'm with Carver State Bank in Savannah, Georgia. Carver is one of the 19 remaining Black-owned financial institutions in the United States of America. Carver was founded in 1927, so this is our 95th birthday. We just celebrated with a big event last Friday down in Savannah. And, I oftentimes invite folks to think about what America was like in 1927 and for a Black man to found a bank in segregated South, for it to still exist. I think about Louis B. Toomer, our founder, who was one of the first Blacks to obtain a commercial real estate brokerage license in the state of Georgia, who started his bank because he wanted to facilitate investments in real estate so he could provide, affordable housing to African Americans in the city of Savannah. And the bank became a commercial bank in 1947, focused on the Black community. And so the institution was founded on the eve of the Great Depression, survived that, went through the World War II, survived that, went through the Civil Rights Movement, survived that, Vietnam, all of these kind of major inflection points in American history and world history, quite frankly, all while most of our history we were faced with legal segregation. And then, systemic issues arising from it. So redlining and disinvestment in the Black community. And all the time, Carver has survived. The reason why we survived is really consistency of leadership. So Mr. Toomer founded the bank. His successor, Mr. Perry, became the president of the bank in 1961, and then our third president became the president in 1971, who was my father, and he just celebrated his 50th anniversary as president of Carver State Bank. And so I've been in a CDFI household my entire life. So I've been connected to the movement before there literally before there was such a thing as a CDFI or a definition for a CDFI, I should put it that way. Really, the nation's Black-owned banks in particular, I think, were the CDFIs for the country in large respect before there was such a term, before there was any federal support, before there was any kind of infrastructure. These institutions were, gathering up resources from within the Black community and focusing them back in that Black community to help people, be able to achieve home ownership or finance their small businesses, purchase a car, or do, just the basic things to be a part of the American system. And we continue to do that to this day. Our institution has, survived these various crises and is still standing in large part because in 1999, we decided, when the CDFI fund was pretty new, we decided to lean into being a CDFI. We saw this program and we're like, well, wait a minute, there's a federal program that is designed to support institutions like ours. We need to lean into that. And that's what really has allowed us to survive to this point. And so we, leaned into the different programs of the CDFI fund. After many, many, many years of trying, we finally were able to win one allocation of New Markets tax credits and then a second one. And so we've been successfully deploying those credits in all across the state of Georgia in urban and rural communities. And those are the ways that have allowed us to be here today, to take advantage of this opportunity in this moment. The other thing I want to mention is that for me, I started to lean into what we were doing as a bank in the CDFI world, and that was really my purview within the bank. And I've gotten a promotion lately. I'm now the CEO of our holding company, and I really kind of cut my teeth in the bank on our CDFI work. When George Floyd was murdered, when the response to Ahmaud Arbery's murder, the racial justice movement, I was in a position, I was kind of at the right place at the right time. And so in addition to my work with the bank, I was asked to serve as chairman of the National Bankers Association, which is the nation's advocacy organization for MDIs, Minority Depository Institutions, sort of the OFN for minority-owned banks. And that was a tremendous honor and tremendous responsibility because we're in this moment in time where, as Defina was saying, there was so much more attention from all the big policymakers. And then all of a sudden, the large banks decided that they were really interested in what we were doing. And so we somehow had to bring all of that together and really not just, access as much capital as we could, but also, try to find ways for us to collaborate as institutions. And so we've been really focused at the MBA on building collaborations among our banks with strategic partners from outside of our sector and with other CDFIs. And so my role now is not just to help our bank grow within the state of Georgia and within the region, but also to kind of help guide the MBA towards collaboration with other CDFIs and with our fellow banks. And so I'm excited about joining this conversation today, and I look forward to the discussion.
Robert, before we move on to Jessel, you said a couple things that if you don't mind pulling out. Language is really important, and you have used the word survive very consistently in your remarks. And the fact that there, as you cited, not only 19 Black-owned, Black-led banks left in the country. Can you pull that thread through for us? Because in the other side of this, we're seeing banks merge and acquire and grow. The big banks and
Yep.
community banks are part of that kind of growth in that part of our sector. So for the benefit of us, can you help us understand the trends and where the MDIs are coming from?
Sure.
And with the opportunities that are in front of us?
Sure, sure. So, the history of Black-owned banks is literally a book. There's a book about it. But just in a nutshell, Black banks were formed just like most other Black institutions in the community. So HBCUs, there were insurance companies that were formed after the Civil War. You have these freed slaves that were looking to establish their own institutions and participate in the American dream. It's really interesting that these institutions were really founded because the freed slaves were looking to save money so that they could, earn their way to purchase property and to be real, true American citizens. And so at one time, there were over 100 Black-owned banks in the United States. Many of them failed because of the Great Depression. But then even at the dawn of the Great Recession, there were still 40 plus Black-owned banks left. And that's not very many, given the fact that there were over 5,000 banks, but still there were 40 Black-owned banks. At the end of the Great Recession, there's only 19. And so what happened? Many of our institutions Black banks in particular, are terribly small in terms of asset size. So the average Black bank was about $360 million in total assets, whereas the average community bank in general was about $4 billion in total assets. If you look at the amount of total assets under management by banks in the United States, last year it was $22 trillion. There were only $6 billion under management by Black banks. That percentage is 27 thousandths of 1%. So the wealth gap between white banks and Black banks is actually greater than the wealth gap between white families and Black families. When Dr. King was assassinated in 1968, he gave a speech the night before he was murdered. And he talked about, he really connected three different things. He connected the right to vote, the right to access to public accommodations, and economic rights. And in particular, in that speech, there's a paragraph in the speech where he calls upon the crowd that was assembled there to support those sanitation workers on strike in Memphis. He calls upon the crowd to remove their money from the white-owned banks in downtown Memphis and deposit their money in Tri-State Bank, which is the Black-owned bank in Memphis, Tennessee. And I think it was so poignant that he made this connection the night before he was killed, because what he was talking about was full American citizenship. And full American citizenship is not just the right to vote. It's not just the right to sit at the lunch counter and eat where you want, but it's also the right to participate in the American dream. And that requires access to capital, which is why our institutions and the other ones that are represented on this call are so critical.
Great, thank you, Robert. Jessel, give us a little bit more about your background and your connection, but also you work for a bigger institution that is driving its resources in an innovative and different way. So help us understand that connection to the conversation today.
Sure, thank you. And thank you for the invitation to this conversation. Good morning, everyone. My name is Jessel Amin, and I'm the Executive Director of Community Development Banking at JPMorgan Chase. So I started my career in the traditional sort of financial services industry. And by my mid-20s, I was sort of feeling quite disillusioned with sort of where I was. And so like many lost 20-something-year-olds, I found myself in business school. And I was really intent on pursuing a career that really helped me to sort of marry my skills in finance with my sort of passion for social justice work. I curated sort of really diverse experiences for myself in business school. I consulted for a startup, and I worked for a cooperative bank, and I worked for a venture fund. I served on a nonprofit board. I worked for a CDFI. And at the time, I really sort of had my eyes set on working in international markets, but for personal reasons, I wasn't able to sort of make the commitment to moving overseas. And then I really learned about CDFI industry, and sort of a light bulb went off. And I found that I could do really deeply impactful work right in my own backyard. And so I ended up joining Capital Impact Partners full-time after my MBA. I joined their finance team and specifically worked on their capitalization strategy. I worked to really expand their presence in the capital markets, managing both of their traditional and their mission-related investments, and also manage relationships with the rating agencies. And I'm so grateful for the work, because it not only challenged me professionally, but it inspired me. And I am and continue to be inspired by the sort of grit and the resilience of the communities that we work with, and the passion and the dedication of my colleagues too. So now in my current role, I really do lean heavily on my experience working at a CDFI, sort of now on the other side of the table as a CDFI lender and a banker at JP Morgan Chase. I really work to try to sort of elevate the voice of the CDFI community into the mainstream financial industry, because I intimately know the challenges that CDFIs face with raising capital. So it's quite a strong pivot to sort of be in the banking sector again, but I really try to lean on the experience that I have and try to work to elevate that voice in the mainstream financial system.
Great. Thank you, Jessel. And I think that was a great segue. What we started the conversation with was kind of the history, not only of our individuals, but where the CDFI and community development finance kind of started and has evolved to. And in this current moment, we are definitely seeing, as Davina cited, resources from the government, banking sector, philanthropy like never before being driven into industries and organizations like ours. For example, in the state of Virginia, a $10 million CDFI grant program was set up in 2021 and just deployed $9.7 million into emerging and existing CDFI here in the state. Brand new to the state of Virginia, brand new to some of the legislators. We had to explain what CDFIs are and how they work. But again, the momentum and the moment that we're in, that's the only reason that happened, was kind of this, everything is kind of coming together. So with that, where we are now, Jessel, help us take this conversation beyond the lending and kind of the traditional banking services. Where are you seeing the innovations, and how are banks like JP Morgan and others playing in this space? And if you have specific programs or partnerships you want to cite, that would be great too.
Sure. And I may be happy to start with sort of a little bit of like maybe the history of sort of how we got here and then sort of what's going on now, if that's okay. So, you know, as Rob had mentioned, CDFIs are part of a sort of a rich history of sort of self-help credit dating back to sort of the immigrant guilds in the Lower East Side of New York City in the 1800s, to Black communities forming the first credit development credit unions in the 1930s. The current CDFI movement as we know it today started to take sort of more formal shape in the 70s and 80s, but it wasn't really until the 1990s that the CDFI industry really expanded significantly in the face of sort of the very persistent and pervasive credit cap that we were seeing. The Clinton administration launched the CDFI fund, and then the CRA, which was an instrumental role in sort of driving capital to our industry. Today, I think, you know, banks are grappling with their legacy of sort of the racist redlining practices that we've seen, and are working to really undo the harm that has been created in disinvested communities. CDFIs rely on banks for access to capital, both in the form of debt and equity, and also traditional sort of treasury banking services. And CDFIs are working to sort of really leverage systemic change by influencing the behavior of sort of more mainstream institutions. So in turn, banks lean on CDFI partners to implement their CRA lending targets in the geographies that they can't reach. But more importantly, banks are leaning on CDFIs to really elevate the needs of their communities and deploy capital in innovative and inclusive ways. But we see CDFIs as far more than just an intermediary. They are value-added partners, both for their investors and for their borrowers. We've continued to see that they build the capacity of borrowers and sometimes of entire communities. Their targeted development strategies with the interplay of capital and technical assistance is responsible for actually building entire markets and developing a customer pipeline. The charter school industry is a great example of that. We see CDFIs, sort of a second layer of that is we see CDFIs sort of closing the structural financing gap, right? So we see deals where CDFIs are, for example, providing pre-development capital, and then in turn, the sort of banks are coming in and providing sort of more of the conventional permanent financing, so sort of laying the runway for that. And then finally, we see CDFIs taking subordinate interests in projects, which make the deals more attractive for banks and other conventional partners. So we see the role of CDFIs as far more than an intermediary and really in this capacity of market building. And so, the relationship between CDFI industry and mainstream financial institutions, I say, and, these are sort of my opinions and not necessarily opinions of broadly Chase, but my opinion is that it is muddied and it is complex, and it is symbiotic and it is evolving. Many people believe that the Community Reinvestment Act is responsible for the catalytic growth that the industry has experienced since the 1990s. But on the other hand, others believe that the CRA is falling short, and there's a major effort underway to sort of reform CRA. And I think one of the most important points to really elevate here is that, and what I think is part of the secret sauce of CDFIs, I apologize, I'm sick, so I'm just going to take a sip of water. What I think is really part of the secret sauce of CDFIs is that they're able to sort of really well navigate the complexities of interfacing with mainstream financial institutions while really operating on the margins of those institutions to be able to actually reach those customers. So there's this constant push and pull that they're trying to influence the behavior of mainstream organizations like the big banks, but then they're trying to reach clients that our banks can't reach. And so there's this push and pull, and CDFIs are really effectively navigating both spaces, and it is complex and it is no sort of easy undertaking to do that. So that's sort of historically looking at the relationship, and looking forward, what I'm really seeing in the financial services industry is that banks are really bringing all their resources to bear right now, from their philanthropy and their corporate responsibility to treasury service and investment banking. We are leaning on all parts of our organizations to be able to better serve our CDFI clients. And CDFI should really be leaning on their banking partners as innovative and collaborative thought partners. I will tell you that I learned so much from the CDFI practitioners that I work with every day. They teach us about risk, how to underwrite it, how to manage it, how to mitigate it, and they elevate the needs of their communities. We in turn apply sort of our expertise in structuring credit to really create holistic capital solutions. And this synergy of sort of the passion and the experience that CDFI practitioners build with our expertise in structuring is really powerful, and is really sort of pushing the envelope. I think banks are going much deeper through their commitment to racial equity. Last year, JP Morgan Chase committed $100 million to equity in MDIs and CDFIs. This sort of equity investment is really new for us. This capital was used to hire staff, invest in technology, and expand into new markets. And we believe that sort of that capital is going to be leveraged, sort of 8 to 10 times to be able to increase lending in communities. Sorry, go ahead.
Oh, go ahead.
So yeah, not only is it sort of just equity, but it's also building the dialogue between our institutions, between banks and MDIs, who sort of on a number of fronts. So looking at, how do we engage and work around technical assistance? How do we talk about loan syndication? There's lots of sort of synergies that are being created through these relationships.
Great. Robert, I saw that you went off mute, and I definitely, as a practitioner in a bank, on our stage today, any reactions or questions or thoughts for Jessel's comments?
Well, it's interesting you ask me that, because Jessel, last night I met your boss for the first time. I met Jamie Dimon. Yeah, he came to Atlanta for a reception, and I got a chance to run in there and meet him. And that was cool because, as the MDIs, the NBA, maybe, I guess it was our convention the last time we had an in-person convention. So this was a year before, maybe it was 2 years before the pandemic. We actually convened this meeting, and we had representatives from, I think, either six or 8 of the 10 largest banks in the U.S. And we renewed our push to get direct equity investments from those institutions into our banks. And this is not something new. This is a call that we've been making for decades. And we had a representative from JP Morgan Chase in the room, folks from Goldman and Bank of America and Wells Fargo, and everyone was in the room. And, we've had meetings like that before at the NBA. And, the conversation, quite frankly, kind of fell on deaf ears. It was just a few months before the pandemic really hit. Wells Fargo announced kind of out of the blue that they were going to make a $50 million equity investment commitment into Black-owned banks. Now, I wasn't in the room for when they made that decision. I'm not sure what prompted it. I can suspect what prompted it, but I'm not going to say that in this forum. But they made a commitment, and then the pandemic hit, then George Floyd, the murder happened, the racial equity movement happened, and then we started to see these equity investments flow. So I'm grateful for the capital, and I was on a panel yesterday about a similar topic, and I was asked the question, what's the difference between the banks or the corporations that are making a commitment for a press release versus those who are actually doing something that's going to be lasting? And I think that's a really important point, because it's not just the JP Morgan Chases or the Wellses or the Bank of Americas of the world that have made these commitments. A lot of corporations made commitments for what they're going to do for the minority communities and the underserved, and they put out these flowery press releases. The question is, what are they going to actually do? Where's the actual commitment? And I'll tell you the difference between the ones that just put the press release out and the ones that are real partners. And I do consider JP Morgan Chase as a company that's trying to be a real partner. Immediately after we completed our equity investment with JP Morgan Chase, they came in and made an equity investment in Carver. They turned around and said, well, what else can we do to help you? So they opened up their ATM network to our customers. Carver is a small bank. We have 2 branches. We have 3 ATMs in the city of Savannah. Now our customers can access the JP Morgan Chase ATM network without paying a fee. That's a big deal, because even with that capital investment, I'm not going to be able to put an ATM on every corner in Savannah, much less across the country or even in the state. And so it's a big deal to let our customers have access to their cash. Now it's about helping us to access some of these corporations and trying to make the linkage between the corporations that want to do something, but they have these very kind of strict treasury policies. And even if we took an investment or a deposit from them, then what are we going to, is the money going to flow directly out of the bank? Is it going to end up being a liability for us? Are they going to really kind of mess with our capital ratios? And I'm getting down in the weeds on some banking stuff that probably most people don't want to talk about. But JP Morgan Chase is helping us with a money market product that can help us to manage some of that. And there's other companies that are doing the same, but then there's the ones that aren't. And I think one of the things that we need to do long-term as a sector, CDFIs and MDIs together, is to hold folks accountable. Say, what did you say you were going to do during the racial justice movement? Let's see what you actually did. And if you haven't done anything, maybe we can help you. Maybe we can make some suggestions. Maybe we can show you how to really partner with local CDFIs, partner with MDIs in ways that make a difference. Because now that we've got capital, and I know, Leah, we'll talk about this, we've got all this capital coming into the sector. Now, how are we going to deploy it? Because you've got small institutions that are used to doing small deals, and now we're going to be a lot bigger. And so how do we deploy that capital? Part of it is going to be partnering with institutions like JP, but also I think collaborating with one another to make capital move with much higher velocity and higher volume.
Jessel, are you still with us? I just want to make sure because your camera is off.
Yeah. Oh.
No.
Can you see me okay?
We can't, but we can hear you. So, okay.
I'll keep going. Yeah, so I agree with you. I think the question is really about sort of capital and commitment, and what are these organizations bringing to the table besides, besides just writing a check, right? Like, what are all of these institutions that have made these large commitments have resources, and what resources, i.e. the sort of the ATMs or the technology, what are they bringing to the table to sort of help with this movement? I think it's a really big part of the story, and we'll hopefully see more sort of in the next couple of years.
Yeah, and I would add to that perspective a little bit on the expectations of community transformation. When we get into program design and providing TA and cycles of grant capital that go with the lending capital are 2-3 year cycles, but community transformation in that time versus 5 years, 10 years, how do we set the expectations around change with the funders, with our partners, in addition to everything that Jessel and Robert shared. Robert, as a way to segue, you have an interesting perspective, and your background not only has you in the private sector, but you are also representing your bank and others in front of the Senate committees and are working very closely at the federal level with policymakers. So could you talk a little bit about how stakeholders in that space are engaging with organizations like yours? Are they taking those lessons deeply in, or are there similar kind of dynamics of how long is this going to last? As far as.
No, I think that's a great question, Leah. I've had the opportunity, as I mentioned before, to serve as chairman of the NBA for the last year, a little over a year. I only have 10 months left, so the clock is ticking. But in that role, I've been able to, testify before House Financial Services, the Senate, the House Small Business Committee, the Senate Banking Committee. And what I have found is that, generally speaking, there's bipartisan agreement about the importance of our sector. CDFIs, MDIs, what we do for small businesses, what we do for communities. I think that there's, it's one of the few areas that I think that there's some bipartisan support. We do have really great leadership, on both sides of the Congress. Really, Senator Warner, your senator, is really our champion on the Senate side. I mean, there's others who are, Senator Warnock is a champion, Senator Sherrod Brown. There's others that are really champions for our sector. But Mark Warner really gets it. He was the driving force behind the founding of your institution. He really understands this at a very granular technical level. And so I'm encouraged because you've got some firepower on the Senate side that really understand what we do. On the House side, of course, I would be remiss if I don't mention Chairman Maxine Waters, who has been a stalwart supporter of MDIs and CDFIs really for decades now. And so her voice, whether she's been in the majority or the minority, has been one that has constantly pushed for us. And we have support from Republicans as well. And so, Senator Crapo, Congressman Perlmutter, you've got some folks that support us on both sides. The administration is a huge supporter. This current administration is a huge supporter. But I want to, even the last administration, you would not have expected for that administration to have done things to support our sector. But, a lot of the money that's coming into our sector came in under the last administration. It wasn't a part of the bills that got passed after President Biden was elected. It was part of the last bills that President Trump signed. And, his Treasury Secretary did things that you would not have expected that ended up being, devolving into benefit for, this huge increase in funding for the CDFI fund. A lot of that stuff would not have happened. And so there is agreement that we've got to do something to create more capital in our sector. So I'm encouraged. I think we continue to need to build the brand, and Davina does this every day. She can talk about it probably more eloquently than I can. We need to build the brand. One of the things we want to focus on is that there is a difference between MDIs and CDFIs, but we do also want to communicate about how we partner. And so I'd love to hear what Davina has to say about this, because this is what she does every day.
Yeah, I'm happy to chime in here. And I, of course, echo everything that Robert said. And, you know, the CDFI industry absolutely enjoys bipartisan support in Congress, which is no small feat, you know, given the sort of deep-rooted partisanship that's present in our government right now. But outside of the influx of kind of pandemic response funding that we've seen, you know, funding for programs that support CDFIs has remained relatively stagnant, and we really have to keep that pressure on for, you know, adequate funding for not just the CDFI funds programs, but the broader suite of community and economic development tools and resources, tax credit, credit enhancement, loan guarantees, low-term, low-cost loans. We really have to keep the pressure on our government to keep strengthening our institutions because we know how to reach and serve, and we want to be working in our underserved communities. And I think what's important is that we don't become victims of our own success and think that our work is done because we got the $12 billion. We're in a period where we've got really supportive government leaders and policies in place, but we now have a chance, I think, to take a harder look at these federal resources and who's accessing them, and are they going deep enough? Are they reaching persistent poverty communities or Black and Brown communities? Are they reaching the institutions that are really rooted in these communities? And it's about having some hard conversations about inequity that might be built into some of these existing programs where, you know, larger, more resource institutions are crowding out smaller, less established organizations, and thinking about how things might be skewed to flow to these certain types of organizations. So I'm actually pleased to see that Congress and the Biden administration, they don't seem to be running from those hard questions. I think there's been a shift in focus on economic and racial justice in underpinning how federal programs are designed and who accesses them. One thing I think that's really important is we've seen the Biden administration actually put forth a number of kind of race-based programs where communities or participants of color are high priority for assistance. An attempt, I think, to right some institutional and systemic injustices, and then they're immediately facing legal challenges that put these programs at risk. And that's a big issue, I think, that's going to play out over the next year or so. The CDFI Fund's Minority Lending Program, aid to Black farmers, the Restaurant Revitalization Fund, even putting a racial equity focus on CRA reform. We're going to need to really defend these programs to make sure that, you know, we make sure these resources are flowing to where we know they're needed the most. So I think, you know, we're in a really exciting time period, but we still have a big fight ahead of us to make sure that we get resources to our capital-starved communities and that we convince policymakers that our communities and our institutions are worth fighting for, even when it's not making, you know, major headlines in the New York Times and the Wall Street Journal.
You know, Leah, I just wanted to jump in really quickly here on mine, because Defina, what you said, I think is really, really important, that we've got to focus on, you know, all of these different programs, right, and how they weave together. And one of the things I think that we need to be doing as a sector is really focusing on the impact and the outcomes. And you know, I'll just be really frank. If we not leverage this $12 billion and we're not able to show real movement on these issues and real improvements in these communities, we're going to, you know, create we're going to have a much longer term problem for our industry and our sector. And so one of the things that community development banks and MDIs don't do well is really report on impact. Generally speaking, the banks don't do a good job of that because we're still banks, right? So we're not used to reporting to grant organizations. We're not used to capturing impact in that way. We're also highly regulated. So there's always someone in the kitchen, right? Looking over your shoulder. So it's like one more report, one more thing to do, but we are going to have to focus on it. And that's one area that I think perhaps we could see some collaboration between the CDFI loan fund group and our community development banks is in helping us on the impact side. We have created at the MBA, one of the things we did last year was we created a nonprofit affiliate, the National Bankers Community Alliance. JP Morgan, Chase, and Wells and some others have really stepped up to support that effort in a significant way. One of the main focuses of that community alliance is impact data gathering, impact reporting, creating a platform for our banks to share that impact. And so, and also to be able to provide that platform for other CDFIs. Because let me tell you, the first thing that Jamie Dimon asked me about last night when I met him at this reception was impact. He was like, I just want to see the impact. He's an investor, so he wants to see the impact. The federal government's going to be is an investor, and they're going to want to see the impact. And it's going to be incumbent upon us to show it. And it's also going to be incumbent upon all of our institutions to be great stewards of these resources. Because the headlines, if money is squandered, if money is wasted, if people buy, expensive cars or whatever it is, those are going to be the headlines, not the great work that most of us are doing. And so I just think that's really important for everyone who's listening to this conversation to take to heart that we've got a great responsibility with these great resources.
Robert, I actually have, I think you might be looking at my notes. I have the actual words written. We have to show impact and, be stewards of capital. And I just, I know we're getting close to time, but I just want to kind of reinforce one thing, which is, we're entering a pretty interesting political period where for the remainder of this Congress, we've got legal challenges to existing programs, global crises, and spending fatigue in DC. That's a bad recipe for community and economic development programs when you're thinking about increasing their funding. And then we're coming up on midterm elections where in the president's first term, historically, his party will lose seats. It's a tough cycle. And so we could be facing a really different set of circumstances in the 118th Congress and a Republican Congress. Even though they like us, they're going to be focused on scaling back government spending, oversight, accountability, and what happened to those trillions of dollars in funds that were deployed during the pandemic. And so we've got to be ready to defend the money that we did get and not be afraid to still lean in and ask for more. And I think, we have to focus not just on the outcomes of, the houses we built, the bank accounts we opened, the businesses we helped, but other ways that we tell our industry story, right? How have these federal funds have grown and strengthened our organizations? What new markets or geographies we've expanded to? What types of products you can offer now that your clients didn't have before? How you're changing the community around you as a result of these investments. I think we still have to really lean in, like Robert said, and figure out how to tell that story of change. We know it's not immediate, but what can we do to show what we're doing and demonstrate that, now's not the time to withdraw or back up or give us less support. We're actually being successful. We're actually doing things, and we need you to support us more and lean in more. And, I also had written down here, like, government is a funder or an investor like other partners. They may not want a market rate of return on their investments, but they want to see what happened with those resources and the impact they're having. And that is 100% our responsibility to be good stewards of that capital.
Yeah, everything you all are saying about impact and measuring that, that's one of our challenges with the Virginia CDFI Coalition, as we're trying to continue to get state resources and honestly set up a healthier industry to be helpful for the state small business credit incentive dollars that our state is getting ready for. We need more community-focused lenders to help with the deployment of that program. So we're trying to use the impact and the stories, Defina, that you're talking about to kind of connect those dots for our policymakers. You gave us some very specific, or you talked about defending that, Defina. Can you give us just some specific, maybe one or two actions that the audience could hear today and maybe file away or take action on when they get back to their desks, so we understand what defend actually looks and feels like?
Yeah, absolutely. So one thing we're thinking about here at OFN is how do we capture the impact of the $1.25 billion in rapid response program grants, right? Which, I think there's going to be a lot of attention to how those funds were deployed and used. And so even though we know a lot of CDFIs, you just got the money a few months ago, you're not going to be able to really show a lot of, outputs or things that have done so far. But how are we writing and capturing those stories of what you're planning to do, what it does for your institution, how it's growing and strengthening your capacity to do other things? So I think one is, thinking beyond the just straight up, units created and things that we're used to reporting to funders, to thinking about how we better and more creatively tell the story, the overall story of our institutions. Our client stories are important too, of course, but I think when it comes to things like equity capital, it can be really hard. It's not a straight through line of we got this $1, it landed in this one project. And so we have to really think about how we tell what happens to a CDFI's balance sheet and what it can do when it gets these types of federal investments. And then the other thing I would say is, build relationships with your local, state, and federal policymakers. I think Virginia Community Capital is a wonderful example of that. Keep them, in your, whatever the digital Rolodexes, but call them up, reach out to their staff, invite them to site visits, let them know what's going on, because that way when they do get questioned or, you know, things come up at hearings where they're sort of asking, well, how's this money being spent and where's it going? There's someone that can defend you and say, hey, I just talked to the CDFI in my congressional district last week, and, you know, they're planning on investing in 3 new childcare facilities, and they're going to, you know, build this affordable housing development in partnership with these other groups. And that type of stuff, I think, you know, there's no substitute for just continuing to communicate what you're doing, having those relationships, because it winds up being a benefit to both the elected officials, who then have something they can tout that they've supported and done, but also to the overall field when we need to go back and make requests for more money and explain, you know, here's what we've been doing with the investments and the faith and trust that you put in us.
Great, thank you. So we have one last section for our conversation today, and then we'll move into the Q&A. And Amir is going to join us back for that part. So audience, please start to put your questions in the Q&A box, and I'll be ready to facilitate those here in about 10 minutes. So as a way to close down this part of our event, I want to think about the future. As we've all said, you know, unprecedented amount of resources and attention for the space that we're in. So when this all works, right, what is different in 5 years for us, or for the communities that we're seeking to support? If you can talk about that vision, but also what are the secret sauce, as I heard someone say today, that will make sure that that actually happens, like partnership instead of competition, stuff like that. What are some of those things that we need to have in place to make sure that vision is in play, actually develops? Jessel, can I start with you?
Sure. And I think like we talked about throughout this conversation, capital is only one piece of it. And what I really want to see in the next 5 years is really an investment in the infrastructure and in investing and gaining sort of operating efficiencies for our CDFIs. And I sort of see that happening in one of 2 ways. One is sort of an investment in infrastructure. So, and that includes investing in our operating systems and our technology. Fintech and innovations are really disrupting the marketplace, both for the banking side and for CDFIs, and we have to be able to keep up with these innovations. We are seeing sort of trends in cryptocurrency and NFTs and blockchains, and I think all of that's going to be relevant to our industry as well, especially as it relates to sort of transparency in nonprofit donations. We have to be able to sort of keep up with all of these trends. And then 2, another way I think that we're going to see operating efficiencies is we're going to start to see sort of more maybe consolidations in this industry. We've seen great alliances such as CDC and Capital Impact Partners, and I think we'll continue to see operating efficiencies from those sorts of structures. You know, I hope that we will, you know, Robert and Dafina talked about impact and data, and I will sort of just drive it in again. I think data collection is huge. It is, and I don't think it's technology that's the barrier. It is the behavioral thing. We need to get better at telling our story. Those of us who are intimately familiar with CDFIs, we know that there is meaningful impact because we see it every day. We see the projects, we meet the beneficiaries, but we're not always able to communicate that story upwards. And we have to do sort of a better job at that and really think about this idea that, you know, the CDFIs were created with a very expressed interest of poverty alleviation. And I don't think we've quite made that connection. We see impact, but the idea of wealth creation and intergenerational wealth, we haven't quite been able to like thread the needle for that story. And I think we got to be able to get there to sort of maximize the use of this capital that's coming into our industry. And then finally, you know, because it's something that I'm so passionate about, I have to say that we need to do the work to invest in talent. We need to attract good talent and we need to retain good talent. The industry is not immune to the fallout of the Great Resignation. Across the board, I'm seeing in the industry that CDFIs are struggling with attracting and retaining talent. And in my experience, the CDFI industry has some of the most passionate and dedicated and smart people that I've ever worked with. But there are real challenges around pay equity and professional development and formalized training or lack thereof, and succession planning. And we gotta work through this. I think, you know, CDFIs are grappling with how to get deployment done. And there's I've seen sort of a strategic shift sort of over the past 20 years or so between sort of CDFI sort of moving back towards sort of grassroots lending, but there is tension in that and related to sort of how do they staff their organizations, how do they manage their portfolios and their investors. It is complex, so it will be interesting to see sort of how all of this plays out over the next few years.
Yeah, Jess, I love what you're saying there, because I think maybe some of the innovations we'll see will be shared services, shared staffing, really doubling down on in a partnership kind of way, but maybe in a tactical, shared benefit package or shared TA portal or something like that. But your point is well taken. So thank you. Robert, do you?
Sure. I'd like to see, in 20 years, I'd like to see that we've actually shrunken the racial wealth gap and it's not continuing to expand. But in the next 5 or 6 years, what I'd like to see is, I think Dafina mentioned this in her comments at the top of the event. As an industry, as a sector, we need to be really honest about racial equity within our industry and sector. Both who is actually making decisions within our sector, and truly are we as a sector applying the same kind of inequitable lens to our lending decisions that the mainstream financial institutions are. And then is there equity in the programs? For years, I was, Don Quixote about the new markets tax credit program. And I was the only one, at least I felt like I was the only one who was waving the flag about this program and how just inequitable it is, and how Black and brown CDFIs that apply for it just don't even stand a chance. It's really, really challenging. And so the racial equity piece, I think, is really important. I think it's also important that we do what Jessel talked about, which is to have more shared platforms and collaboration. I'd like to see us combine in lending as our institutions get bigger, and as there's a pressure to get more capital out, we can actually do bigger projects, but we still got to band together. So with the emergency capital investment program dollars that are coming into CDFI banks and credit unions, there's an incredible leveraging opportunity there. So now our bank will, for example, be big enough to start making investments into CDFI loan funds. That's something that we can do now that we wouldn't have been able to do previously. So I want to be able to start partnering with and making loans, low-cost loans to loan funds to help them to increase their impact. I'd like to see us, but I'd also like to see us do big syndications together. So if it's, going out to Arkansas and helping to create affordable housing, or helping to do a manufacturing plant in Tennessee or in Texas that's going to create a lot of quality jobs, or do clean energy projects across the South or the West, those are deals that now our industry can syndicate together and do together, and perhaps have the structuring assistance of a large bank like a JP or a Goldman or whoever. And then the last piece is really getting back to the piece about impact, but connecting the impact story to actual poverty alleviation, and really being able to move the needle there, so that when we get to that 20-year mark, we can see that the wealth gap has actually narrowed.
Thank you, Robert. Dafina?
Yep. So I think I'll echo a couple of things that were already said, but to Robert's point, like just deeper and better partnerships within the CDFI industry. So there's divisions between the community development credit unions and the community development banks and the loan funds and MDIs, and it's just not helpful or necessary. So how are we actually putting our ego and self-interest aside to actually work together towards the mission of improving communities and improving the lives of the people that we're all here to serve? So I think that's a big one for me. Real inroads on closing the racial wealth gap. It's not going to go away in 5 years, but can we show that we're actually getting somewhere and achieving things, or even just show how our institutions are helping to move the needle on it, and what we're lifting up, what we're able to do differently that isn't coming from mainstream finance. adopting and leveraging technology is a huge one. There's just going to be, I think, more and more requests for information and data. We have, small business lenders having to report on Section 1071 is going to be coming soon. That's going to be a big change for loan funds and smaller banks that aren't used to capturing and reporting that type of information. So how are we helping institutions grow into these new expectations from funders around the information that they're going to be gathering and sharing back out with them? And then just, expanded markets and geographic coverage. We're still only 1,300 institutions as a CDFI field. So more CDFIs and MDIs, stronger CDFIs, going broader and deeper and making sure that, any community where there's a need for access to affordable, responsible financial products and services understands that there's a CDFI and or an MDI that is available to meet their needs. I think that's really important too.
Yeah. Davina, your last comment there reminded me of something Donna Gambrell shared with me. She's CEO of the Appalachian Community Capital and former of the CDFI Fund. A lot of us on this call probably know who she is, but she mentioned on a podcast that there are only 1,200 CDFIs across the country, and there's over 5,000 banks. And what would it mean for our communities if we could double the number of CDFIs and loan funds that are in the spaces that we're in? So I like to think about that, especially here in Virginia. What would it look like if we had twice as many CDFIs and loan funds kind of doing the work that we're built to do? Thank you for that dynamic and engaging conversation. We have lots of questions coming in from the audience. So I do want to grab a hold of those and get those in front of you all. But as our host and VCC CEO, I want to yield the first question to Amir. And if he has one for the group, and also audience, if you have questions for Amir, he's going to stay up here with us. And so I can get those to him as well.
Thanks, Leah. And Davina, Robert, and Jessel, thank you so much for participating today on our Learning Exchange event. You brought so much rich information and content for us to learn and to grow from. My question really is sort of built on the same theme of what's been discussed the whole way through, which is this idea of how do we improve collaboration. And I think the thing that really strikes me and what I'd like to get all of your opinions on is credit risk management. It's clearly one of the things that defines why we exist as CDFIs, to sort of bridge between the credit that's available by mainstream institutions and the credit that's needed by communities. But, just sitting at an institution that has both a bank and a loan fund, it's immediately present to us how the credit management requirements, often driven by regulation, are vastly different between what we can do as a bank versus what we can do as a loan fund. So I'm just curious for you all as a group, what are some of the things you might see as ways in which we can address this issue? And, obviously, Jessel and Robert come from different types of institutions, so I'm curious from that perspective. But Davina, you do a lot of work on sort of trying to break that issue down from a policy perspective with the regulators as well. So start with whomever, it doesn't matter to me, but just really curious from your perspectives.
That question is a mouthful, Amir. We could have a whole 90-minute seminar just kind of talking about that. Now that one would be pretty boring though. People would start to sign out. But I think it's something that we grapple with too. I mean, one of the things that I've learned from my observation of VCC and sitting with Jane at conferences years ago and trying to understand the different structures of a lot of the CDFI certified banks is that we've got to try to adopt, we as these historic MDIs have got to try to adopt some of the practices and strategies of the newer CDFIs, the newer community development banks. And one of them was having a nonprofit affiliate. And so we set up a nonprofit affiliate to Carver a few years ago, and we were able to get it certified as a CDFI last year. I think that's really important because we've got to have that, we need to have that loan fund element that can help us get deeper into the credit box, and really get outside of just that regulatory restricted box. The other thing I think would be important is for us to get with some of these corporations that have made these big dollar commitments And let's see if we, and not just the corporations, but also the philanthropic community that's sitting on these huge balance sheets. How can we apply those balance sheets to helping us to mitigate credit risk? I'm literally working on 3 different projects right now for Black entrepreneurs, and the thing that is the connecting through line for all of them is that they have great plans for either businesses that are going to have high impact in low income communities, or providing affordable housing in communities of color, but they don't have deep pockets and they don't have wealth, they don't have credit. And so how do I bridge that? And I think that there needs to be a connection between some of the deep pockets of the meaningful, the well-meaning philanthropic community and corporate community, and these entrepreneurs who are pushing for change in their communities. I think we could create some tools that would allow us to be able to extend credit to those folks. And so I'd like to keep working. I know you guys are working on something, and you and I need to schedule a time to talk about some of that stuff because we've got some ideas. But we really want to try to leverage some of the wealth in America to allow people who haven't had the opportunity to create wealth to create it and generate and create change.
Kind of to hook off of that, and I'm seeing a question from the Q&A. Maybe some of those tools, Robert, and others, are things like equity investments. And so one question from the audience is, are you seeing a trend in CDFIs providing equity investments? If so, how are they succeeding and what are their pitfalls?
I'll try to take a quick stab at it. One of the things that has happened as a result of the ESIP program is many of our banks are looking at how they can climb the capital stack. Banks are traditionally debt lenders, right? So we're traditionally in that 80% slice of the capital stack, providing some debt to a project. But that 20% piece is the piece where we have this challenge, which is the equity piece. And so you have programs like the New Markets Tax Credit Program that sort of addresses that, but that's very limited in how you can use it, and it's flexible but limited. It has a whole lot of hurdles you got to jump through. One of the spaces that we're considering is a private equity space. And are there private equity players that really want to focus on investing in minority-owned businesses, where maybe our banks, because we've got access to this additional capital, can both invest in the private equity, but also have really better equitized companies to lend to, minority companies to lend to. And that's an area where I think you'll see some change. I'm not sure, I can comment on whether we've actually started to make equity investments, and we haven't. But it's an area that we're really strongly considering because we have more capital, so now we have an opportunity to kind of climb the capital stack.
Other reactions from the?
Yeah, I would just say that I think that equity is just one piece of it. We're also seeing sort of more other structures like convertible debt and sort of those sorts of structures or enhancements. So I think, equity is just one piece of it. There's lots of tools that CDFIs need to bring to the table to be able to serve their clients.
Well, speaking of another tool, this is more of a, it's a tax program, but there is a question from the audience around opportunity zones. And Gina, maybe with your ear up on Capitol Hill. So commenting on how have you seen any impact from the Opportunity Zone program? And is this still a viable tool, for investment in underserved communities? And I would add, do you predict its continuation under the Biden administration?
This has been, one of the more controversial, I think, quote unquote, community development tools that have been created recently. And I think that for the institutions like, Enterprise and LISC, that have really been able to take the complex financing structure and make it work for their organizations, you have been able to see that be a very effective community development tool. But in general, some of the data I've seen is that it's mostly, going to kind of high net worth individuals. It's not there were no guardrails put in place to ensure that any of these activities actually had to have any real community development purpose. There's no reporting on what's actually happening with the investments. And so you can imagine that it's not necessarily having the impact that we thought it could early on, and that there's really not going to be any good data or information to kind of show that it didn't have the impact. So I think I would imagine it's, somewhat unlikely that it's going to continue under the Biden administration. And if it does, it would need some significant reforms. There have been a little bit of, efforts on the Hill to, get guardrails in place, put some reforms in, but those haven't really succeeded thus far. So, it might just be that this is going to be perceived as this was something that was put in place under the previous administration, and we don't want nothing to do with it. So that would be my answer to that.
Great. Well, I'm looking through. I think we've covered most of what was touched on from the audience. Maybe Amir, if Robert talked about the ESIP program and some of his thoughts around what they're going to drive at Carver State. But we have a question from from Roger. Please comment on the expected impact of the ESIP program. So Amir, do you mind touching on that for us?
Yeah, sure. I think Virginia Community Capital, similar to Carver State Bank, was fortunate enough to be awarded a ESIP investment. We're treating ours as preferred common equity. And what that allows us to do, as with any sort of banking institution, is effectively grow your leverage that you can your essentially your tier one asset base to be able to leverage further and grow your lending portfolio. What is really unique about this money is that it has so many requirements around it in terms of it actually having to have community impact, that and then it also has the incentive attached to it such that if you meet that commitment at a scaled level, effectively what's a 2-year period of financing at zero cost turns into a 10-year financing at a very discounted dividend rate that you have to pay back for that common equity. So I think our goal at VCC, probably similar to Robert's, is to figure out how do we not only deploy such a great form of capital, but to really take risk and do things that historically we might not have been able to do with our balance sheet. Similar to how Robert described the approaches that they're looking at taking, we want to figure out how do we use our capital as a bit of a wholesale funding source for CDFIs and other mission aligned funds across Virginia that, just can't get access to that discounted capital without, either federal funding or a really generous philanthropic contribution allowing them to do so. So this actually creates, in many ways, an opportunity for us to be either a wholesaler or possibly a secondary market for mission aligned intermediaries across the state. And we're blessed that the hard work of the VCC team and Jane Henderson under her leadership over the last 15 years created such a stable balance sheet, though. So we're able to then just grow from what we have as a stable base. I'd like to figure out how we're able to do that as quickly as possible and be able to get that capital out there to support it. But I think it's also interesting for us. There are lots of IDAs and economic development agencies and other municipal agencies that have a desire to do community-based financing and are looking for another source of funding. And so for us, ESIP also gives us a chance to kind of go back to those transactions that we might not have been able to do a year ago, 2 years ago, and reconsider doing that type of work in partnership with the state.
Great, thank you. We have one last question from Farmville, Virginia, and then I'll go ahead and close this out because we're close to the end of our event. While I address this question, if anyone here on our stage today wishes I would have asked you a specific question, or if there's one point that we didn't get to today that you want to leave with the audience, go ahead and ask you to think about that, and we'll do that as our way to end today. So Sharon from Farmville, she is asking how a community action agency serving that region begins to connect to this journey. And Sharon, I'm assuming, how do you connect to the resources and the work that we're doing here today? Simply put, I can get you a list of CDFIs serving the South Side of Virginia, and we can connect you to the right partner once we understand more about what your agency is trying to achieve. But it comes back to partnership and community relationships. And so we can help you do that from the VCC perspective, and would be happy to. With that, anything to add to the conversation today before we close down?
I did want to just comment on Amir's initial question around risk and credit risk management. And I think this is something that does, have a through line to both the sort of private sector, but also in the public sector work and advocacy. There's just still a very real perception of risk that's not aligned with what the historical experience has been of the CDFI industry and our institutions. And we really still do have a lot of work to do to change this mindset that you can't lend money to poor people and get paid back, and that our institutions are inherently riskier because of the people and places that we serve. And to me, that has always been the biggest obstacle when trying to convince a public sector, worker or a member of Congress, elected official, that they should give their next dollar of taxpayer money to the CDFI industry, is that they just think that we're giving out money to any random person on the street corner and we don't know what we're doing. And I think that, is something we have to really think hard about, how we overcome the idea that because of where we are and who we serve, that, it's not a good bet for any of our partners.
Leah, I think, first of all, thank you for a great conversation. And thank you to Virginia Community Capital for hosting this important meeting and opportunity for us to talk about how we can collaborate across the CDFI industry. I just want to maybe reemphasize that we're all in this together. If the loan funds fail or the MDIs fail, it's all going to reflect, it's going to reflect on all of us. And so, I think, I can't remember who it was that quoted Donna Gambrell, but talking about what would happen if we had more CDFI loan funds. But what would happen if we work together and stop fighting each other over, and stop having this kind of zero-sum mentality. So if we would go together to Washington to continue to press for more funding for all of us, I think we can, and if we're able to show that we're willing to work together and not compete with one another, I think that it would go a long way to making our sector stronger, but also strengthening the communities that we're trying to serve. And so I'd like to see us all work together and stop viewing each other as competitors.
Yeah, I echo the sentiments of both of Davina and Robert, and I think summed up in that if you want to go fast, go alone. If you want to go far, go together. And I think that sort of sums up what we've been talking about today.
Yeah, thank you, Jessel. I was trying to remember that proverb. Thank you. Again, thank you for joining us, everybody here in our audience, and to our guests today. Thank you for making time to have this important discussion as part of our learning exchange. Amir, thank you for hosting. And Valerie, is there anything that we need to know before we go off into the rest of our day?
Just a reminder that we're going to be sending out a follow-up email next week that includes the recording of this conversation, and please share it with your networks and folks who weren't able to join us today. And just a final thank you to Davina, Jessel, and Robert, and my colleagues Amir and Leah for having this conversation today. It was wonderful. I learned a lot, and we look forward to continuing this conversation with other learning exchange events throughout the year. So just keep an eye and an ear open for our other events, including a larger capstone event at the end of the year. And as always, please give us a call, VCC, if there's anything that we can do. VAcommunitycapital.org is our website. And seek out your local CDFI if you're not in Virginia, and see if there's ways to partner. And thank you.
Thank you.
Thank you,
All
everyone.
right.
Bye.
Have a great day.
Thanks
Thank you.
everyone for joining. Thank you so much.